Okay, so we're going to pick up where we left off the other day, going over about halfway through quiz number 2, and we'll move into quiz 3 and hopefully finish that up today. Okay, so that's where we stopped off here. During the month of March, Harley's Computer Services made purchases on account totaling $45,300. Also during the month of March, Harley was paid $10,700 by a customer for services to be provided in the future and paid $37,800 of cash on its accounts payable balance. If the balance in the accounts payable account at the beginning of March was $78,200, what is the balance in accounts payable at the end of March? Okay, anytime we're asked about a balance in an account, my suggestion would be to do a T account or a T chart to track that. Okay, so we're told accounts payable, leave it there, beginning balance was $78,200. That's on the credit side there. And then we just want to look at each of these transactions that happen and see if those in fact touched the accounts payable account. If they did, we'll just throw them into this T chart. So the first one made purchases on account totaling $45,300. Okay, purchases on account tells we owe money, we purchased something, we didn't pay for it. So that first one is an addition to accounts payable. Okay, that goes on the credit side because it's a liability. You have to forgive the fact that I don't have an actual T here, but you can see I've indented for the credit side, and we'll put any debits to the far left there. Let's see. Harley was paid $10,700 by a customer for services to be provided in the future. Okay, that one there is irrelevant to accounts payable. Okay, because that's talking about unearned revenue. We haven't provided the revenue yet. They gave us money. That would go into a liability account, but since we're not, the deal is not they give us money, we give them their money back. The deal is they give us money, we give them either services or goods, right? So when that happens, we would record a liability, but it would be an unearned revenue liability. So that $10,700, irrelevant to accounts payable, which is what this question asks. Doesn't mean we wouldn't do a journal entry and keep track of it, just not in the accounts payable account. Okay, so the next one was paid, we paid $37,800 of our accounts payable balance. So if we're paying off part of this accounts payable, that goes on the debit side to show that it's being reduced. Then we have, that was the last transaction there. So now all we're doing is adding these two together, $78,200 plus $45,300, and subtracting $37,800. Remember, we're adding those two on the right side because this account carries a credit balance. So when we make additions to this account, they go on the credit side. So, pull up my calculator here. $78,200 plus $45,300 minus $37,800. And my overall balance is $85,700 credit balance. Okay, so the place where probably a lot of people get confused here is just knowing debit, credit, and making sure that additions to the account go on the credit side. Okay, any questions on that one? Okay, next question. I included the answer choices. See if I can get them all on the screen here. Given the following errors, identify the one by itself that will cause the trial balance to be out of balance. Okay, so trial balance, basically, if you remember what I said when we look at the trial balance, what we're looking for is, do debits equal credits? Okay, so right away, if we're told which one of these is going to cause the trial balance to be out of balance. The only way that happens is if a single transaction does not include equal amounts of debits and credits. So we just look at these and see if any of them do not include an equal number of debits and credits. Okay? So right away I'm looking right here. And what does that show me there? 160 debit, 16 credit. Okay? So if it does not include an equal number of debits and credits, it's going to put us out of balance. So that would be my answer choice there. Okay, next one. Smiles Entertainment had the following accounts and balances as of December 31st. And what it's asking us to do, use the table, calculate company's reported net income for the period. Okay, so basically need to know what's the definition of net income. And if you know what's on the income statement, you got revenues, you got expenses, and they total to net income. So we're just going to look at this chart. We're going to see, where'd my calculator go? We're going to see which ones are all the revenues, which ones are the expenses, and we'll just subtract expenses from revenues. Okay? So generally when you see a chart like this, almost always they're going to put them in order. Assets first, liabilities second, equity third. Okay? So in this case, the revenue and expense affect the equity section. So they're in the bottom section there, and you see the only thing that you really need to be careful of here is to make sure you don't see an account somewhere in here that says unearned revenue and attribute that to the revenue account. Otherwise, it's as simple as looking for accounts that say revenue on them and subtract and adding those up and then subtracting any accounts that say expense. Okay, in this case, we have one revenue account, we have two expense accounts. So revenue is 8,700, so I have 8,700, and I'm going to subtract from that salaries expense and utilities expense. So minus 670 minus 1340. Okay, so yes, sir.
What if, like, say, salaries expense 670 was on the credit side? Would you still do the same thing?
Okay, so expenses carry a debit balance typically. So if you saw that, well, I should say this way. If a seasoned accountant saw that, they would immediately think something's probably wrong there. Okay, because really, to be honest, the only time you would ever see a debit or an expense that's not a debit is if someone made a mistake and was reversing out what they did. Okay, if I made a mistake and put it in the wrong account, the way to reverse that is by putting a credit in there instead of a debit. Okay, but under normal circumstances, ordinary course of business, always debits. Okay, good question though. Okay, so the answer here is 6690. Simple as looking for revenue, subtract expense. Caution, only make sure you're not including unearned revenue. Okay, Gold Digger Services provide services to clients. On May 1st, a client prepaid Gold Digger $72,000 for 6 months of services in advance. Gold Digger Services general journal entry to record this transaction would be what? Okay, we're being prepaid. We're from the perspective of Gold Digger here. We're being prepaid that amount for services we've not yet provided. That should key you into the fact that this is not going to be earned revenue. If we're receiving money and it's not earned revenue, that means it's unearned revenue. Okay? But we do want to track the fact that we received money. So, of course, if we received cash, we need a debit to cash for the amount we received. Okay? And then the credit side of that journal entry, unearned revenue, or in this case it may be labeled unearned service revenue. Either way, unearned in the title, revenue in the title, full amount there. Okay? And then the question doesn't ask this, but if later on down the road, after we do the work, we earn this revenue, so we would further journal entries to show we earned it, would be a debit to earned revenue, showing that going down, and a credit to earned revenue. Okay? So in the future, the only thing that happens here is these numbers will gradually roll over from unearned revenue to earned revenue. As it stands, their liabilities, when they roll over, they turn into revenue that affects the owner's equity side. Questions on that one? Okay. Able Graphics received a $760 utility bill for the current month's electricity. It's not due until the end of the next month, which is when they intend to pay it. I didn't include the choices here, so we'll just come up with what the journal entry looks like to record this transaction. Okay, a couple of key words here. We received this utility bill for this month's electricity, meaning we already used it. So this month's electricity has been used to generate, hopefully, this month's revenue, right? So we want to match it. So that means, since we're trying to match that expense to current revenue, we want to make sure as soon as we get this bill, if we're recording it right away, we want to make sure that we're recording an expense. Remember, to have it be a recognized expense, we need to have it go into some type of expense account. And like I said, those generally carry a debit balance. To increase an expense account, you debit it. So, debit, whoops, write the account on here first. Again, not worried that you know it would be utilities expense, but you should definitely know that it should be some type of expense account. Okay, so we have a debit to utilities expense, $760, and credit is going to be to some account that shows us we owe this money. So it will be some type of payable account. Could either be, the likely choices here would either be utilities payable, or if it's a small company, they may just include all of them together within accounts payable. So that's my journal entry. Recognize the expense, put it on the books that I owe money to someone. Then once I paid this off, I would debit the payable to show that goes away and credit whatever I used to pay. Cash, probably. Okay. Oops. Why this one's taking up so much of the screen here, but all right. Wiley Hill opened Hill's Repairs on March 1st of the current year. During March, the following transactions occurred, and got cut off there. Okay, let's just look at what the question asked. Based on the information here in 1 through 9, the balance in Wiley Hill Capital reported on the statement of owner's equity at the end of March would be what? Okay, so basically what we're concerned with, we want to look at Wiley's capital account or owner's equity account that records basically the effects of all the transactions that touched Wiley's capital account. So we want to go through each of these categories and see which of these categories would have affected his or her, I guess it could be a her, capital account. So just right off the bat, just kind of rattling through them, if Wiley invests cash in the business, that does affect Wiley's capital account because that's capital that Wiley contributed to the business. Wiley contributes equipment to the business. Again, that would show up in Wiley's capital account because Wiley's contributing to the business. That increases assets in the business, which increases Wiley's capital in the business. Okay. Company paid $2,700 cash to rent office space for the month. Okay, so basically any of these within this category that are either a revenue or an expense will also affect the capital account. Okay, so we have paid cash here, that's an expense. Received cash here for services provided, that's revenue. Paid $6,900 salaries, that's an expense. Provided $3,700 of services to customers on account, that's revenue because we provided services. Company paid cash of $1,200 for utilities, that's an expense. Received $3,800 in advance because we haven't paid or we haven't provided these services yet. So that would actually be unearned revenue and would not yet affect capital account. And then finally, Wiley withdrew this amount for personal use. Okay, so once I've established which of these affect the capital account, I would just add and subtract based on whether I said it affected it or not. Okay, so starting with the first one, $32,000 increases the capital account. Okay, contribution of $107,000 increases the capital account. Okay, paid expense, that's going to decrease the capital account. Received $23,000 cash, that's earned revenue, increase. Whoops. I have to start over there. Yeah, I can't just, with this calculator, I can't just erase that one part. All right, sorry. 32,000 plus 107,000 minus 2,700 plus 23,000 minus 6,900 plus 3,700 minus 1,200. That's the unearned revenue in number 8, so we won't do anything with that one. And then finally, withdrawing money from the company reduces capital. So my total there would be $149,200. Okay, and again, if it is easier to understand, might be useful in a situation like this where it's asking about a specific account, to draw a T-chart, T account, and put it in there to see what the effects are. Okay. Otherwise, also fairly easy to just add and subtract. Any questions on that one? Okay. These following transactions occurred in the month of July. What was the amount of revenue for July? So again, we just look at each one of these transactions, determine if it was revenue, and add it up. Okay. Received $910 cash for services provided to a customer during July. Yes. That's revenue. Received $2,300 cash investment from Bob Johnson, the owner of the business. No, not revenue. Didn't get the money from providing our normal services. Got it from the owner, which is capital. Received $760 from a customer in partial payment of his account receivable, which arose from sales in June. So whenever that sale occurred in June, we would have recorded the revenue at that point. So we're not going to record it again in July, so we won't add it this time. It would have already been recorded in revenue. Provided services to a customer on credit. Since we provided the services already, we would recognize that revenue. So we're going to add that. Borrowed $6,100 from the bank, nothing to do with revenue, and received $1,260 cash from a customer for services to be rendered next year. Unearned revenue, so that wouldn't help us either. $1,295 is the total of those that are revenue from July. Any questions on that one? Okay, last one for this chapter. Andrea Apple, and this one cuts off again. But basically, let's look at the question at the bottom here. Based on the information provided here, the balance in the cash account at the end of January would be what? Okay, so again, we're looking at cash. Might be helpful to make a T-chart, but we just want to look at each of these transactions and say, yes, it did affect the cash account, or no, it did not. Okay, Andrea invested $15,200 cash in the business. Yes, that would increase cash in the business. So we'll add that. Contributed $37,000 of photography equipment to the business. Equipment is not cash, so we will not include number 2. Company paid $3,800 cash for an insurance policy. Did cash go down? Yes, it did. We paid it. So I'm going to subtract $3,800. Number 4, the company received $7,400 cash. Don't even need to read the rest of it. I received cash, so yes, my cash account is going to be affected. Whoops. Yeah, that's right. Company purchased $7,900 on credit. No cash changed hands on that one. Company provided $4,450 of services on account. No cash changes hands. Company paid cash, $3,200. So I'm going to subtract cash, $3,200. Company paid $4,800 on the office equipment purchased in transaction 5. So in transaction 5, it was credit. We're now paying off $4,800 of that. So I'm going to subtract $4,800. We paid in cash. And finally paid $445 cash for January utilities. So I will subtract that. Based on that information, the ending balance would be $10,355. Again, just needed to know or pay attention to which ones of these transactions involved cash. Okay? All right, any questions on that one before we move on to chapter 3? Okay, move that out of the way. All right, this is chapter 3 questions here. Again, I think there was only one ratio question in this chapter, but I did exclude that one. But something I did do for these questions is I did check to see how many of you missed them. So on this first question, only 26% of you got it right. So maybe good to pay attention to this one. Sanborn Company has 10 employees who earn a total of $2,000 in salaries each working day. They were paid on Monday for the 5-day work week ending on the previous Friday. Assume the year ended December 31st, that's a Wednesday, and all employees will be paid salaries for 5 full days on the following Monday. As of December 31st, what is the adjusting entry that needs to be made? Okay. So, paid on Monday for the previous 5 days. Okay. So if the year ends December 31st on a Wednesday, we've essentially worked 3 days that week, and we need to do an adjusting entry that shows us recognizing salaries expense for those 3 days and recognizing that we owe a payable. Okay, so I'm going to have a debit. Debit to salaries expense for, we're told, $2,000 per working day. We got 3 working days. So the total there is going to be $6,000. Let me blow that up a little bit here. Whoops. Okay. Well. Oops. All right, this is being recorded, so I don't want to get it too far out of my recording area here, so I'm just going to leave it small. I'll say what it is. I'm also going to post these answers, so don't worry about writing them down. Credit here, again, is going to be to some type of payable. In this case, salaries payable for $6,000. Okay, so 3 days worth that we need to record there because December 31st is when we're going to do our financial statements and such. Okay, next question. November 1st. So this is the answer here for the first one. Debit salaries expense $6,000. Credit salaries payable $6,000. November 1st, Jovel Company loaned another company $250,000 at a 12% interest rate. The note receivable plus interest will not be collected until March 1st of the following year. The company's annual accounting period ends on December 31st. What is the amount of interest revenue that should be reported in the first year? Okay, so a couple of stages to this problem. And over here is where I have the percentage that got it right. This column here is y'all's class. So 30% of the people got this one right. Okay, so we're given an interest rate. That's for the annual interest rate. Okay, we're given a time period here. November 1st is when this happened. So we have 2 months that we're worried about here, November and December. Okay, so the first thing we need to do is change this interest rate, the annual rate, and change that to what it would be for 2 months worth. Okay, they gave us an easy one, 12%. That means 1% per month, basically. Okay, so in this case, for 2 months worth, we have 2% of this $250,000 that we're going to owe for interest. Okay, so all I have to do to figure out the amount is multiply 250,000 times 2%, and we get $5,000. Okay, so $5,000 is the amount of interest revenue that would be owed on this note payable as of December 31st. Okay, so the trick there obviously is knowing, instead of doing the full year's interest calculation, that you should only calculate it for the 2 months there. Let's see. January 1st, a company purchased a 5-year insurance policy for $2,200 with coverage starting immediately. If the purchase was recorded in the prepaid insurance account and the company records adjustments only at year end, what's the adjusting entry at the end of the year? 76% of you guys got this one right. Okay, so we purchased a 5-year insurance policy, okay, on January 1st. We're not recording anything on it until the year end. So basically, from January 1st to December 31st, we use up 1 year's worth of this insurance policy, which is a 5-year policy, okay? So the first thing we want to do is figure out what the amount of money, how much worth of this policy we use up in 1 year. So to do that, we're just dividing the 5-year policy premium into 5 years. Okay, so I have 2,200 divided by 5, $440 per year. Okay, once I figured that out, excuse me, thank you. Once I figured that out, then I just need to know what the journal entry looks like to plug that 440 in, right? So again, what we're doing, after we use up a year's worth, we want to recognize insurance expense for that amount, and we want to show that our prepaid insurance has been reduced. So to recognize expense, we debit some type of expense account. We know the amount's 440. So in this case, whoops, that wouldn't be salaries expense, sorry. Insurance expense. And then we're going to credit prepaid insurance to show that we've reduced the amount in prepaid insurance by 440. Okay, most of you all did fairly well on that. I know we covered at least a couple examples in the class of that, so hopefully that helped. And I should have put the amount there on the top. Okay, next one, 43% of you got right. Company recorded 2 days of accrued salaries of $1,450 for its employees on January 31st. On February 9th, it paid its employees $7,100 for these accrued salaries and for other salaries earned through February 9th. the January 31st and February 9th journal entries are what? Okay, so we have two journal entries. One on January 31st. That is when we recorded that we owed these salaries. Okay, so if you remember the format for that, you want to record an expense because we have incurred the salaries expense for those people for $14.50. And that first one is going to be some type of payables account, salaries payable in this case, showing that we are still need to pay those people $14.50 for their services as of January 31st. Okay, so that's the first part. Second part, we're going to go ahead and pay off that payable, and in addition to that, we're going to pay the additional amount of money that was earned. Okay, so the debit side is going to include a couple of things. It's going to include us recognizing the expense of these extra amount of work that was done between January 31st and February 9th. So that's going to be the difference between $14.50 and $7,100. Okay? So if I want to do it in my spreadsheet here, just have $7,100 minus $14.50, and the amount there is $5,650. Okay? Second part is I'm going to debit the full amount of salaries payable that I already recorded right up here, $14.50, to show that that one is now no longer something I owe. And theoretically, we probably paid this amount in cash, so I'm going to credit cash for the total that was paid on February 9th of $7,100. Okay, just like the one we did in class that I said was slightly more complicated. Okay. On July 1st, a company paid $4,800 premium for a one-year insurance policy with benefits beginning on that date. What will be the insurance expense on the annual income statement for the current year ended December 31st? Okay, only trick to this question is realizing that since we started in July, we're not talking about a full year's worth of insurance expense here. So we want to know period from July 1st to December 31st. Well, that's 6 months, half a year. Okay, so that's just going to be $2,400 or half of the 1 year premium. It's not asking for the journal entry, just asking how much insurance expense I've recognized during this period. Okay, so that's it. $2,400 insurance expense, half of the year that we prepaid. Okay, January 1st, Eastern College received $1,220,000 from its students for the spring semester that it recorded in unearned tuition and fees. The term spans 4 months beginning on January 2nd. The college spreads the revenue evenly over the months of the term. What amount of tuition revenue should the college recognize on the last day of February? Okay, so basically, if it's a 4-month term, February 28th essentially is the end of the second month. So we're going to look at half of the term being completed. So if we spread it evenly over the whole term, we're just talking about half of this revenue. Okay, so half of $1,220,000 is $610,000. What's that?
That's not how they solved it.
What do you mean that's not how
I
they
did the
solved it?
same thing and I got the answer wrong.
Oh, really?
Yeah. The numbers are different. Yeah, the numbers are different on the quiz, but the fact is that what you just did is different. They only used quarter of it.
So that one might have been wrong on the quiz then. Okay? Because if we're talking about one semester, which this question clearly is.
Right. That's what I came up with, the exact thing.
So if you guys come up with a question like that and you're like, this doesn't make sense why it's wrong, let me know and I'll change it. These are not infallible. The quiz, I mean, I find questions wrong on the auto-generated homeworks and quizzes all the time. So just let me know and I'll change it. Yeah, everyone will get points on that. Okay, let me make a note of that real quick here. Yeah, I was wondering because I thought that one was pretty easy and 36% only got it right. So, I might have mentioned before too that since the book or the software rotates in numbers, so they may have only put the wrong answer in for one of the 4 or 5 sets of numbers. So some of you guys may have seen numbers that actually were correct versus other people not.
It gives a formula at the bottom for the answer, and then they're saying take that number, divide by 4, and it gets the answer.
But it shows your specific set of numbers, right?
Yeah.
So I mean, I'm just saying it generates that for each set of numbers.
Okay.
So theoretically, some of you could have seen the right numbers, but obviously yours didn't. And probably a lot more considering the amount of people missed it. So yeah, but either way, I'm going to give everyone credit for it. That was, let me just highlight that. So you are able to look at what your answers were now.
Now, yeah, I pulled it up today.
Okay.
I can start seeing it.
Cool. Have you looked for any of the other quizzes?
Yes.
And it shows it for all of them? Sweet. Okay. At least that's finally working. Okay. Yes. I apologize for that. I changed the settings like 2 weeks ago, so I'm not sure why it's just not working. Okay, physical count of... Did anyone have a question on this one other than that one having marked it wrong? Yeah.
Yeah, it could be backtracking. Just to question number 2. I mean, obviously the numbers are a little different, but on the formula it says divide the, for me it's 200,000 times 9%, times 60 over 360.
Yeah, so the 60 over 360 is them just, it's changing the steps from the way I did it, but 60 over 360 times the percentage gives you the percent that you would multiply by, and then you would take that and multiply it by the number. But you should come out to the same answer.
Yeah.
Just a different approach of how you do it. I don't like the way they do it because putting a number over 360 to me is confusing because there's not 360 days in the year. But if you just think about it, that no matter how many days were in the month, you count one month as 1/12, and you come out the same way. Okay. Where was I? Okay. Number 7. Physical count of supplies on hand at the end of May for Masters Inc. indicated $1,244 of supplies on hand. The general ledger balance before any adjustment is $2,040. What is the adjusting entry that needs to be made? Okay, so again, helpful to do a T-chart. So we'll say supplies there. And we started with a balance of, in the general ledger, it shows a balance of 2040. And we know that at the end of the day, we want that to show the actual balance of 1244. So what do we need to do to get from a debit of 2040 to a debit of 1244? Well, we figure out what the difference is between 2040 and 1244, and we put that on the credit side. Okay, so that is going to be the credit portion of this entry is going to be a credit to supplies for whatever the difference is there. Okay, so that would be what? 756, 796, I think. Okay, that's the credit side. And then the debit side is just going to reflect the fact that we used up these supplies, so we want to recognize the expense. Okay, so it's going to be a debit to supplies expense, 796. Okay, so if you do this journal entry, that effect on the supplies T-chart crediting 796 will give us what we want, an ending balance that's accurately reflecting what we counted, 1,244. Any questions on that one? Okay. Question 8 was a ratio question. 90% of you got it right, so I was right that those are easy for most of you at least. Number 9, company had no office supplies available at the beginning of the year. Okay, so basically the balance at the beginning of the year was 0 in that account. During the year, the company purchased $430 of office supplies. On December 31st, $155 of office supplies remained. How much should the company report as office supplies expense for the year? So again, office supplies, T-chart, starts with a balance of 0. At some point, we purchased $430. That's going to be a debit to office supplies for $430, right? At the end of the day, we've got $155 left. That's our balance. So a very same type of problem as the last one. How do we get from $430 debit to $155 debit here? Well, we want to credit office supplies for the difference, okay? And that amount that we credit office supplies for the difference is going to be what our supplies expense for the year is, because the journal entry would be a debit to supplies expense and a credit to supplies, okay? So in this case, the difference between those two is what? 275. So our journal entry would have a debit to supplies expense for 275, and since that's the only supplies expense we had, that's what the expense for the year would be, 275. Of course, if we were finishing this journal entry, supplies would also have a credit of 275. Questions on that one? Okay. Sanborn Company rents space to a tenant for $2,600 per month. The tenant currently owes rent for November and December. Tenant has agreed to pay November, December, and January rents in full on January 15th and has agreed not to fall behind again. We don't care about that part. As of December 31st, what entry needs to be made? Okay, they've occupied the building. Since we're the landlords, we earned money for the months of November and December that were occupied, right? So, since we earned money, we're going to have some type of revenue showing up here, right? We're also owed money by someone else. That means that we're going to record that in some type of receivable. Someone owes us money, we will receive it in the future. So, this could either be, depending on our company, accounts receivable, rent receivable, something with the word receivable in it, okay? 2 months worth, $2,600 per month, so $5,200. And the credit side could be just revenue, if that's the only thing we do. Could be rent revenue. Whatever the case may be, it's going to be a revenue account, and it's not going to say unearned revenue. Anybody have any questions on that one? Yes, sir.
You said she's going to pay for all three. Why would you only count 3 months?
Because as of December 31st, we only earned 2 months worth, right? So all we're doing on December 31st is recording the fact they've occupied the place for 2 months so far. We've earned that money. We need to put that in our books. What happens in January, we think that's going to happen. We think they're going to owe us money in January. And at the end of January, when this person pays us, then we'll record the effect of that payment for all three. But as of December 31st, we just care about recording what has already happened so that our statements are accurate for the year. Okay? Any other questions on that one? Okay, we are out of time for today. Looks like we had about 4 more.
So, did you do the last one maybe?
Probably not in the last 2 minutes, but I'll record the rest of them and post them up. Okay? So I'll just pause this recording.